Okay. Now we're recording. Oh, dear. All right, so we're done with that. Great. And now we can move on and check out the markets. Except, oh, where's my thing? Wow. That was weird. I can't access this, whatever you call this bottom thing, taskbar. Wasn't letting me in. Okay, so we got out of our, we should look at that. We got out of our silver trade and we got out of our natural gas trade. Now, neither one of them yesterday was Wednesday, I called them out over here in the morning part of the session. I said, let's get out of these things. So we were fine. We made a good call on natural gas. Silver, though, interestingly enough, let's take a look at Wednesday here. Silver, interestingly enough, it wasn't 1540. It actually today, it went down. We were pleased that we got out because it went down to 1520. Then this morning it went to 1550. Silver is crazy. Still, it was a really, really good trade. We made tons of money, and that's what we were on for last week, right? Those were the leftovers from last week's session. I talked about that in the Morning Post. Let's see. I got to bring that back. So in the Morning Post, you can see this was where we ended up. Well, that's when I exited anyway, 31.50 and 26.20. And that was down around 10 o'clock into yesterday, sometime into yesterday's sessions where I took the exit. So right about just under 1540 there and 221 there. And we'll compare that to where we actually are now. I mean, 221 was fine. That's right here. So that was a good call. But the 1540 I kind of regret now, right? Because it seemed like a good call at the time. And it was, frankly. I mean, look, we could have gotten out and gotten back in because 1525 was our entry point. So we could have gotten right back in at 1525 and caught the next 25 cents again. I personally didn't because I had just gotten out and I wasn't even looking at silver this morning. But here it was, right back at our entry point at 2 o'clock in the morning. And in fact, all last night it was over there. But boy, you got to have balls of steel to ride out this trade because it's just insane. These are thousands of dollars up and down constantly. Your account goes up and down like a yo-yo when you're trading silver. So, sorry about this. I can't access the taskbar properly. Let's see how we're doing if anybody has. So if you have questions, get them out early because I don't want to do this thing where everybody has the last minute. What makes the dollar go higher? If it's higher, then silver goes lower, right? Well, look, the dollar tends to have a short-term effect on prices. So in other words, okay, silver finishes yesterday at 1525, right? And the dollar goes down 1%. 1% of 1525 is 15 cents. So, yes, silver will probably, if the dollar goes down 1% today, then silver will go from 1525 to 1540 today, reacting to the dollar. But tomorrow, it'll drift back. If the dollar stays put, it'll start drifting back towards where it was at 1525. The dollar has a short-term effect, not really a lasting effect on prices. They tend to, prices tend to go where they're going, and they're mitigated by the dollar, especially in short-term trading. In short-term trading, you have an almost direct effect. In long-term trading, well, first of all, that depends on the long-term trend of the dollar, because the dollar's going up and down and up and down and up and down. What's more important is what's the actual trend of the dollar over the long period. So you have to look at a bigger chart like here, USD. So take a big chart like that. So here, you have a serious uptrend in the dollar from 80 to 100. So that's up 25%. That's putting pressure on the markets, putting downward pressure on the markets. So let's look at that. From July of 14 until March of 15, the dollar went up 20%. And technically, we're still basically up 20%, SPX. So now we'll look at the S&P during that period. And from July of 14 until March of 15, we did go up. We had this big dip here, and that was when the dollar pressure was very high. But as the dollar calmed down, see, this is the point though. So the dollar was putting pressure on the market. As the dollar was going up here, 20%, right? It put pressure on the S&P, which dropped like 10%. But then the S&P started recovering. It dealt with the new reality of the dollar and it starts coming back. Since here, the dollar's been basically flat, and the S&P has just done what it would do anyway. So it's a short-term effect. It doesn't have a lasting effect. The indexes are going to do what they're going to do, and they're not going to pay much attention to dollar pricing. All right. Although, look, in reality, with the dollar being up so much from where it was, I mean, if you're an American, this is nice, because if you're an American, here you go, you had the dollar at 80, and even with the Fed nonsense of what they're doing, they are trying to weaken it. They keep making moves to weaken the dollar. They keep printing this money. But even with these moves to try to weaken the dollar, they're not doing it. They're not just not getting it because the other countries are pushing even harder to weaken their currency. And that's the thing. It's all relative, and it's all a big system. And you have to realize like everything's connected, and Europe's connected to the United States, and then we're connected to Asia, and we're connected to China. So it's not all just about one thing. The dollar is definitely a factor, though, and where you're mostly going to see it is the immediate pricing pressure it's going to have on things. So yeah, if you start seeing the dollar turn down, like in the short term. So let's see where it is right now. Currencies. So the dollar in the short term went down, and you can see everything popping up because of that. This is well, that's not short term. Hang on, hours. So you see this move from 96 to 94.50 is 1.5%, let's say, right? And then you look over at the metals, and we went from 12.20 to 12.40, which is, well, what's 1.5%? That'd be like 18. In fact, that's 12.30 would be 18. So 1.5%, and that's where we ended up. See, that's the thing. It overextended the 1.5% move. Then it fell in line with the 1.5% move. And now that the dollar's kind of flatlining, silver's going to go back to where it wanted to be, which is probably 12.25. I'm sorry, that's gold. And silver's going to go back to where it wanted to be, which is 15.25. And copper. Meanwhile, if you want to look at what's really going on, copper is the best indication of what's really going on. There's no demand. There's no demand for industrial metal. All right? Silver follows gold around, but silver is more like an industrial metal than it is a precious metal. And silver should really be closely tracking copper. It shouldn't be flying up with gold. It's not an inflation hedge. It's not a realistic exchange for currency. It's just too cheap. It doesn't work. It works better than copper, but it doesn't work. I mean, the reason gold is good is because you get $1,000, $1,200 for a little tiny piece of gold. That's reasonable. If you're storing money somewhere, I can actually store in the space of let's say you have $5,000, right? Or 10,000. Let's say 10,000. 10,000 is one of those bankrolls of 100. So when you get hundreds in a big fat stack, that's $10,000, right? Obviously, 10 gold coins take up less space than $10,000 worth of bills. So therefore, for storage purposes, for transportation purposes, other than the weight, obviously, where there's a difference in weight, but for storage, transportation, for putting away in safes and things like that, gold is actually better than dollars. They don't have high enough denomination dollars to make it better to store currency. And that's why they're having a debate about whether or not they're going to keep the 500 euro note, because that's the number one thing criminals like to use, because the more money you can put in a smaller amount of space, the better it is for people who try to move it illegally. And if you can't do it with money, if you can't do it with euros, you're going to do it with dollars. And if you can't do it with dollars, you can do it with gold. All right, and an even better way to move money around is diamonds. Okay, there are women going through airports with like 5 or 6 rings that are worth like $100,000 each ring, and so that goes. They blow right through security, which is amazing to me, because they all these times like you can't take $10,000 worth of cash, but they let women with $100,000 rings walk right through. And it's like, that's just as good as cash. You can go from one freaking country to the other and change it, and you buy the ring in one place and sell it in another place. I mean, obviously, unless you're getting ripped off. But I mean, these guys know what they're doing. They have their own diamond dealers, and they move their stuff like that. They buy it here and they sell it there. So, you know, there's always a way to move money. It's just silly to try to crack down on all these people. And, boy, we've got no questions. Okay, I'll just ramble on and talk about what I feel like talking about. What do I feel like talking about? I forgot. I had a topic this morning. All right, portfolio management. I know what I wanted to talk about. All right, so this morning we were talking about tomorrow officially, Draghi announced, remember we had a big market rally, futures, indices, days. Okay, we had this huge market rally because Draghi and the Fed and everybody says more free money, more free money, more free money. Now, tomorrow, though, is the day that the ECB actually starts putting the money into play. All they did here is announce that they're going to start putting the money into the market. This was Draghi ahead of the Fed. I'm not sure exactly when Draghi went, but he was a bit ahead of the Fed. And he said, we're going to start increasing. Don't forget, they're already putting $60 billion a month of QE into the market. 60 billion euros, which is $70 billion, let's say. So they're already putting 70 billion or 75 billion a month into the market in their current QE. He's increasing that by 25%. So 25% of 75 is 20. All right, so he's increasing it by about $1 billion a day. So that's what they're doing. So the additional $1 billion a day is going to start, it's 33% increase, not 25% increase. It's a 33% increase. So it's at least $1 billion a day. And that starts on tomorrow, basically. Tomorrow's the first day of the increased operation. Is it enough to lift the European stocks? Well, in fact, here, you see how this is ahead of the Fed? Here's where Draghi announced it, and it started moving Europe. Europe gapped up. See how Europe gapped up? So here's Draghi, and then here's our Fed like a day later or something like that. They came like right on the heels of each other. We've got more of an effect out of our Fed not actually doing anything, just changing their language, than they do out of Draghi actually taking another $1 billion a day and throwing it into the market. You know, asset purchases or whatever they're doing with it. You've also got China increasing the money that goes into the market and allowing banks to do more purchasing. You've got Japan pushing more pension fund money into the market. Everybody's doing everything they can to prop up the market, and this is all they get. That should make you nervous. It shouldn't make you. It shouldn't make you complacent. This is complacency. You should be nervous, not complacent. This is wrong. All this reaction is wrong, and I'm not happy about it. All right, so. All right, so there's that. So there's the background of where we're at. I mean, look, they couldn't possibly do more to prop up the market other than actually having the government hand out money again, you know, like other than having some kind of rebates or refunds or things like that to prop up the markets further. So this is probably as good as it gets, and that means you're going to have to sit there and go through earnings. Earnings are going to suck almost guaranteed. Earnings are going to be terrible this quarter. In most sectors, especially energy, financial, and materials, are going to be terrible, terrible earnings, and those guys go early too. Energy companies and financial companies go pretty early in the earnings cycle. So starting right about April 15th, tax day, although I think you have to be 18th this year, but starting around April 15th, you're going to see a lot of earnings reports that are going to start making people really, really nervous. So it's a really good time to start looking at positions, saying, can I cash these out? Is it a good time? It's a good time to move more money to the sideline and get over there and try to ride out what's probably going to be a dip in April. And if it's not a dip, so what? So you know what? Frankly, if it's not a dip, that means there's going to be tons of energy companies to buy really cheaply, right? Because the market's so good and things weren't so bad. Therefore, energy and materials are going to be a great place to put some more money to work. You know, but so I don't see the downside really to getting to more cash. The only downside, you might miss a little something, but frankly, the way we've gained lately with our portfolio, in fact, these are our portfolios. I was looking at it. Just since Friday, where's Friday? Not Friday, Sunday, sorry. So Sunday before I left, I went to Atlantic City for the weekend, or for, well, not the weekend, but whatever, starting on Sunday. I left for Atlantic City on Sunday. In the morning, I did a portfolio review, or I finished a portfolio review anyway. So this portfolio review, you know, the long and short-term portfolios are at $1.3 million, and that's up 124% since November of 2013. So it's just a bit over 2 years. I mean, it's just, you know, when you're up that much, it doesn't hurt to go to cash. It's not like you're going to die if you miss something. And having that kind of cash to deploy is very useful. There's almost no time when that's not a good thing to have money to deploy. It's not terrible to go back to cash sometimes and look at the broad landscape from a detached point of view and say, okay, well, you know, I have any skin in the game, so I'll just look for something good to get into. Even our butterfly portfolio is up stupidly. Anyway, so here was the review I did on Friday, so I'm not going to get all into it. But the point is, without touching it, because I went away for 3 days and I didn't make any calls to change the portfolio or anything, because when I go away, I got a big portable computer I take, but it's not as good as my home setup, so I tend not to make any trades when I'm on the road. So we left our portfolios alone, but even leaving them alone, since they're still generally poised bullish, the short-term portfolio gained 2.6%. The long-term portfolio gained 5%. This is just Monday, Tuesday, Wednesday. The butterfly portfolio gained 7.2%, and the options opportunity portfolio, which we call the 5% portfolio, is up, gained 5.6%. That's since Sunday. That's since I wrote this on Sunday. So since Friday's close. And I'm not sure where they're at today. We can take a look. Let me refresh this. 26.5. Okay, so that's about the same. The butterfly portfolio, this is for today's intraday, 146 on the butterfly. Where was that? Butterfly, 146. So they gained a tiny bit on the butterfly portfolio because now it's 146.6. And the short-term portfolio, 385. And that was what? 390. See, the short-term portfolio lost some money. And the long-term portfolio, so, you know, you take these balances with a grain of salt, they go up and down. You know, when you're dealing with this much money, they go up and down pretty quickly. And the long-term portfolio is 78.5, very nice. Okay, and that was this morning, 77. So the long-term portfolio gained 1.5%, and the short-term portfolio lost like $5,000. So this lost $5,000, and 885, and now the long-term portfolio is 892. So we gained $7,000 here, and the short-term portfolio, we didn't change these. We didn't make the changes yet in the thing. We got a little more bearish. And the short-term is 485.5, and it was 487. So it's working exactly like it should be. The short-term portfolio lost $2,500, but the long-term portfolio, which is bullish, gained $7,000. So the long-term, and don't forget, it's not just bullish, the long-term portfolio. First of all, we covered a lot of positions. It's bullish, and we sold a ton of premium. So in a flat market, we make money in the long-term portfolio. In an up market, we make money in the long-term portfolio. The only way we lose money in the long-term portfolio is in a down market. Flat or up, we make money because we sold a lot of premium. So every day, more and more of the premium that we sold expires or becomes, or not expires, but it deteriorates over time. That's called theta decay. And so every day, considering that we've got like $1 million worth of positions, every day, all the short positions that we've sold grind down a little bit. So it's normal in the long-term portfolio in a flat day to even make a couple of $1,000 in a flat day. That's just a normal day for us in the long-term portfolio. All right, the only time we lose is in a down cycle, and so we want the short-term portfolio. It lost $2,500 today. We wanted to lose $2,500 when the long-term portfolio is going up. That means we're balanced more or less properly. Okay, in fact, it's exactly the right amount because we gained 3 times more in the long-term portfolio than we lost in the short-term portfolio because we're still technically bullish. If the market turns back, then the short-term portfolio will gain 5,000 while the long-term portfolio maybe loses 7,000. And so we're mitigating a large portion of the damage. But we're going to have to look at all these positions carefully next week, and we're going to have to, if we're going to start unwinding, and we're going to have to, like, you got to be careful. It's like playing Jenga. You got to pull one peg out at a time and try not to make the whole thing fall apart. Because it's very easy to unbalance your portfolio when you're pulling your positions, and you don't realize like one thing just turns you much more bearish than you thought, or much more bullish than you thought by just pulling out one certain position. That's why I like to do it when we're at a top like this, because when we're at a top like this, it's easy to do because I can say, okay, let's sell all our profitable longs. There's no harm in that, right? Every time you sell a more profitable long, you're getting more bearish. And you don't have to do it all at once. You do it on, I'll say every day the market goes up, I'm going to sell another 1 or 2 long positions that are profitable. And that means that I could stop at any time. So if the market goes up 1%, I'm going to sell 3 more longs. Let's say I have 30 longs, right? So the market goes up 1%, I'm going to sell 3 more longs. It goes up 2%, I'm going to sell 3 more longs. Another percent, I'm going to sell 3 more longs. So as it keeps going up, I'm selling more and more longs. And every time I sell my longs, I'm getting more and more bearish, right? And then finally, when the market's up 10% more than I thought it was going to be, now I'm freaking bearish. All right, and that's a good rule. And you know what? If I'm wrong, so what? Because I made all this freaking money on my longs before I got out, and now my shorts are losing money. I'm like, so what? So now I'm going to liquidate and say, okay, maybe my strategy was wrong. Maybe we're actually going up more than this. And again, don't forget that doesn't really happen. Though. That only happened in 1999. In real life, you don't keep going up 10% every 6 months. That's just not normal. I mean, although, as freaky as these markets are, it's normal in China. And we're getting there. We're getting to be like China. We're manipulating our markets like crazy. All right, questions. Now we have some questions. Craig says, do I think oil will make another run to 39 for the month and the NYMEX close, or is it done popping for the day? Oil? I mean, my answer on oil is I wouldn't make a call on it right now. It's too freaky. But there you go. I mean, look, it popped back off 38. We got down 38.50, fell a bit below, and now it's coming back. So it looks like it's going to make a run up. And it's Thursday, and Thursdays tend to be up days. You tend to close up towards the weekend. For gasoline, I think gasoline is a better play at 145. It's 1453 now. I would play gasoline bullish here rather than oil at 1453 because gasoline on a Thursday very often moves higher. Very, very often. Like so often that just is a random. If you want to statistically take a play, I'd say 2 out of 3 Thursdays you're going to go from any kind of low. If you hit a trough like this, you can count on usually a couple of pennies. So we're not there yet. We're at 144. I would say 146 here would be your target. And it's not here. Let's trade it. Oh, what happened there? Oh, come on, advertising. So we'll look at RB. Ugh, what an ugly spread. I mean, these are only hundredths of a penny, but it just annoys the crap out of me when you have a spread like that. But if we take RB, look, it's getting away from us too. All right, so 1454. Oh my God, really? Come on. Oh wait, I got it. Okay. All right, so let's assume it goes to 1456. So gasoline, very expensive thing to trade, okay? It moves very quickly. You got hundredths of a penny. So I'm looking for a 600th of a penny gain here. And my premise is that it's going to go up to 146 or higher possibly. All right, so we'll see how that goes into the close. Natural gas is coming back down, which is great because we got out of it. This would be so cool. If it fails this line and starts plunging lower, we can get all the way back down to where we want to buy in down here. All right, I mean, the weather's warming up. It's not really a good time for natural gas. There's no particular fundamental driving it. Fine, so I'm not going to look at natural gas right now, but it would be great if it blows 216 there and starts plunging. That would be the best, because then we can get back into it. And here's oil. So like I said, we got one long share here. We're looking at oil, and we're hoping oil gets back over this midpoint. And if oil goes back over the midpoint at 38.75, then almost certainly you would expect gasoline to go over its midpoint. All right, so we'll just see what happens. I'll have to watch that one. That's an easy trade. Let's see. So we'll keep an eye on that, but that's your oil question answered. As to oil itself, I wouldn't trade it right now. Update on the LL trade. We still have an LL trade. I don't know. I mean, it's update. What do you want me to say? We still like it. Lumber Liquidators is, what? It's 13. I mean, I don't understand. The Lumber Liquidators trade, if we, it's not the short term. In the options, I can't imagine you're asking about the long-term portfolio one. That's 2018. Here, this is January. Okay, it's not even April yet. It's only April tomorrow. Okay, so as of April, we have a $10 call. We sold the $18 call. The net on that was $3, let's say, minus $4. We have a $1 credit because we also sold the 13 puts. So anything over 12 is break even for us. We break even at 12 because we got a $1 credit. We sold the $13 puts. No, I'm sorry. It's even better than that because we have the $10 calls. So 11, let's say. Anything over 11 is a profit for us. So we're at 13. So what would my update be? Wait. Update. April. It's April. So we have 8 more months. That's my update on the Liquidators. It's an 8-month play. We're in month 4 or whatever. So I'm not, it's on track. It's doing what it's supposed to do. Where do we see the dollar going? I say this is the range of the dollar. We're in the proper range. It's there's nothing strange about what's going on here. If we look at the longer term, here, let's blow that up. We'll go to weeks, months. Okay. Look, in the grand scheme of things, the dollar is still it's still about in the lower part of its overall range. So let's say the range is really here from 90 to maybe 110. And we'll say this is stupid, and probably this is stupid too. So realistically, 90 to 110 is probably about right. So 100 is right where the middle of the range should be. But with the Fed's easy money policies, we're going to stay in the lower part of that range. So we're going to be in the 100 to 90 range. And I think 95 is probably a good bottom. We're obviously below 95, but I think 95 should more or less hold. And you can see here, more or less it holds. These are months, so you have to give the month time to resolve because this down spike here will look just like that if we recover by the end of the month. Well, the end of March it wouldn't work, obviously, but. Let's see how it forms up at 95 to get a better view of it here. We don't spend much time below 95 because as crazy as our Fed policies are, the policies of the other central banks are crazier. So unless they stop their easing and we keep easing, there's no reason for us to get this weak again. So in the paradigm that we have now, where the U.S. is the only country that's not easing or not maintaining the easing, we're not tightening though either. That's the thing. So right now you have just this initial disappointment of the dollar bulls and look, the dollar bulls got killed. They got crushed. The Yellen just destroyed. They thought it was going up. We had Nabob on our site. He's been screaming King Dollar for 6 months now, and it never. I keep saying it, so I'm like, you're wrong. I told him back here. He was forecasting 110 or whatever it was. And I'm like, no, because you got to be realistic about what's going on in the world. It's not like we're easing. Just because we're not doing any new QE, we're still doing the same QE we were doing. We haven't really pulled back on the QE that we were doing. So we're still throwing money into the market constantly too. So it's all relative, and it's just got to watch what everyone else does. But in reality, Europe is not going to change their stance. Japan is not going to start tightening. China is not going to start tightening. They did a little bit. Actually, I'm sorry. China did. That's one of the reasons the dollar is weak today, because China did actually make the yuan stronger today. But nothing significant, and their currency isn't very significant anyway. And then you've got Europe and you've got Canada. I mean, who's going to step up and start making their currency stronger to make the dollar weaker? It's just not going to happen. So realistically, this is weak for the dollar. Down around here is a weak point. So if I was going to play currency, I'd play the dollar bullish here, but I wouldn't play until it crossed over 95, and I'd use 95 for a stop. It's a good point. By the way, when you're playing anything, especially in the future, though, where every penny is like a ton of money, then you don't enter at 94.54. If your premise is that you're going back up, then you wait, because if your premise is right, you're going to cross over 95 and you'll keep going up. Then you wait to cross over 95. Don't play under 95. Even if you're right, 95 is going to be resistance. So your premise is that the dollar is going to go up when it crosses over 95, like here. See, here's my premise that the dollar is going to get stronger, right? When it crosses over 95, I enter, and then when it goes up, and when it stops, when the momentum stops, I get out of the trade. And then when it goes back under 95, I wait, and then when it goes up, I take the trade, and then when the momentum stops, I get out. Then it goes below, and I do nothing. And when it goes back over, I get on the trade, and now look what happens. I get a fantastic run like that. Discipline, though. Wait for it to cross up. See all the money you can make? Cross up. And of course, this is, like October, December, March. Not March, silly. Wait. I don't know. I just realized this is the year. So whatever this is, these are weeks, aren't they? So this will be June. So this has to be April. Let's go at April, and this would be May at some point. Then this is like July. Then this is August, and this is September. So you have 4 or 5 times last year that you could make that play on the same premise, and it's easy money. But it's only easy money if you're patient and you wait. And you wait for the right setup, and you don't chase it, and you don't sit there and go, oh, it went under, I'm going to play it over here. No, because then it goes further down. If you play it over here when it first went under, you get burned for days. Who knows what it is. Look at it. It's a terrible, terrible move against you. There's no reason to chance it, okay? These things go up and down over the lines. If your premise is right, it's going to go over the line, stay over the line, and keep going up. That's when you make your money. And if it's not doing that, don't play it. Just go find something else to do, which is something I pretty much have to say to Craig every day. It's like it's not every day. It's not a good day to trade. The same thing with oil. It's so easy to make money trading oil if you wait for it to hit a certain spot. On the daily calendar, we haven't been in this range for very long. But if you look at where I want to go long is 37.50. So I'm looking for 37.50. We had it here and we had it here. Both were easy money at 37.50. We didn't quite get 37.50 here, so we took 38. Still easy money, $1,000 move on 38. Over here we took 38, had a $1,500 move. Over here we took 38.50 because 38.50 maybe 38.60 or whatever. But here we did it here. But we were looking in this area to go long. Below 38.50, we're definitely interested in taking a long position because we think the range, this is the range. 37.50 to 42.50 is the trading range for oil. So when it's down below 38.50 in the lower quadrant of that range, we want to look for a long opportunity. So we look for bottoming action like this, and we take a long position. When it's up here, we look for topping action, and we go short because our bias is to the downside when it's up here. It's not complicated. Because it's a range. That's what a range is. It's going to mostly stay in the top or bottom of your range. So your bias shifts depending on which side of $40 you're at. It's either going to be 250 below or 250 above. The closer it is to this line, the more you want to go short. The closer it is to that line, the more you want to go long. That's it. It is not complicated at all. Now, if something fundamentally changes, then we would change our lines. Or if the dollar drastically changed, which it did actually, the dollar got weaker and it isn't helping. That should make you very cautious about your entries here. Dollar is much weaker, not helping. Got to look at the same time frame, otherwise you screw yourself up. So you look at hours on the dollar, $1.97 to 95. That's down 2% since March 16th. Now we go back to oil. All right, so here's the same thing. March 15th, the dollar has been down 2% during the same time frame. So if anything, oil is probably, another 2%. What's 2% of 37.50 is what, like 70 cents? So that 38.20. So that's why. So 38.50. This is why we're making these turns here. You see that? The reason this line is holding up is because the dollar is that's how much weaker the dollar is from 37.50 to here. The dollar has moved that line up. Because oil is very dollar dependent. Because oil, obviously oil, what's oil traded for? It's traded for dollars. That's the whole point of the exchange. All oil is traded for dollars worldwide. There's only one thing you do with oil. You trade it in for dollars. So when the dollar's down 2%, you can expect that line to move up 2%. And if the dollar starts going up, then there's going to be more pressure on this, and that line's going to move back down, and oil's going to fall. So, right now, this support is because of a weak dollar. All this support here is from the dollar getting weaker and weaker. But that's not a good sign, because if the dollar starts getting stronger, this will easily fall back down to 37.50 and maybe even below as the dollar starts climbing. And again, this is not complicated stuff. There's only really two things you're looking at. What's oil? What's the dollar? It's just you have to take these factors into account, though, when you're making these trades. All right, IBM, yeah, IBM is doing wonderfully. I mean, it's a nice thing. I know the Fed is slowing the interest rate projections, but do you think a large cap financials are reflecting no hikes, the AC in particular? Bank of America is a really good stock. The problem with banks is they have a very, they're very tight. The spreads are very, wrong thing, BAC. The spreads that the banks lend interest rate on is very tight, so it's hard for them to make money. But Bank of America has very little problem loans on their books, and they're quite undervalued here. I do like them as a value play on Bank of America. I'm sorry, what was the question? Let's figure out what that question was. Financially reflecting no hikes. Yeah, but no hikes is kind of a bad, at this point with the rates this low, the no hikes is not a good thing for the banks, and that's what they're looking at. But, now I got my thing back. Isn't that funny? All right. Look, everybody's getting weaker. Oh, what was that trade wearing? Oh, gas. That's okay. All right. Okay, I'm like, what were we even trading? All right, now you see the Russell with the dollar now. Let's take a look at the dollar since we're in an energy trade. DX. Nice. Okay, so the dollar's coming up. Gasoline's going up anyway. The indexes are coming down. 2060 was rejected. 110. Oh, I was going to say we should short below 110. Let's do a short here. I wanted to short below 1110, and it went below so fast I didn't have time to say it. So we're going to take one short here below 1110, and we'll get out if it goes over, because our premise is that everything looks like it's getting weaker. 2055 fell too easily. The dollar's moving up a little bit, and we'll see what happens. I didn't see any particular news, but we'll worry about that later. So this is just our usual Thursday trade, and this is just based on the fact that we expect a little bit of a sell-off. First of all, the reason you're going to get a sell-off is because there are people who are obviously propping up the market. But then there are people who want to take advantage of that large sellers take advantage of those people because there's people who are basically forced to buy right now. So the people who are forced to buy, you can dump your shares on them and they'll buy them. And so you have a good chance to unload large positions by getting the people who are trying to prop up the markets to prop it up into the close. So that's fun. Fun things to do when you're a hedge fund manager. All right, now, Bank of America, that's what we were looking at. So I like Bank of America down here as a long-term trade. And if we take a look at BAC, and we look at, I don't care less about anything but 2018. They're at $13.50. I am very happy to own them for, 13 is not a bad price. So I would sell these for $1.80, the $13 puts, and you can take that and you can buy the $13 calls for $245. Let's sell $240. Okay, so $240, and what can we sell? And we sell the 17s for 89 for, let's say, 85. So what's 240 minus 85 is 160, 155. So 155 minus 175 is going to be a 20-cent credit. So you can get a 20-cent credit on the spread. So your worst case is you own BAC for $12.80, okay? But you've got the $10, you got the $13 call. So anything over, so if Bank of America gets to 17, you're going to make $4.20. You're going to make your credit of 20 cents plus the $4 on the spread. So that's a nice way to play it because you really don't need Bank of America to make much of a move to make, a really nice return. You're tying up very little cash, and I guarantee you that this has almost no margin. Let's take a look at what it says. If we sell these, and I'm selling, if I sell 10 of these guys for $1.75, let's get $1.80 for them. If I sell them for $1.80, look at that, $1,200. So I'm going to get an $1,800. I'm going to get $1,800 paid, and I'm only using $1,200 of margin. So I get that plus the upside. So my upside is $4,000, and I'm only using $1,200 of margin. So that's a nice margin-efficient way to play. The short $13 puts for $1.80, and then the spread for like $1.55. The 13-17 spread for like $1.55. And so you get about a 20-cent credit on the overall play. You're going to use about $1,000 in margin, or let's say $1,200 in margin, and your upside return is $4,200 if it hits 17. So a very nice way to play, and your worst case is you own it for where it is now, for $13. That's your worst case. But your leverage is tremendous to the upside, and you're using much less cash to make the same trade. So it's a nice mellow way to play Bank of America. And I definitely like them for a long-term trade. Not that it won't get cheaper, not that we won't have a little bit of a crash, but, I wouldn't make it a giant position. I'd make it but as an entry position, sure, I like it. Do you trade VXX now? It seems like a good time. No, I don't trade VXX. John Luke trades VXX. You can talk to him about that all day long. He loves that thing. It's so, what's the word? It's so emotional. It's not. There's no logic to it. It just goes up and down with sentiment. So it's not like there are fundamentals that drive it. I mean, you can make some educated guesses, but on the whole, it's not the best thing to look at. Reflecting, not reflecting. Yeah. The power option site, is this linked to Thinkorswim or are those manual entries? Those are manual entries initially. You have to enter those manually. There are ways to link it up. I'm not smart enough to do that, frankly. I forget what they... I don't know. You can call these guys. They give good technical support. But they do have some way to link stuff or do something to work with some brokers, but I just can never figure it out, so I don't bother. I mean, I just use it to have a neat... I like the way they track stuff. I really do. I like the way they organize it and track things. It's so useful to me. Declan, would you short the ES here at these levels now heading to the quarter? Well, we just shorted the Russell, so would I short the S&P? Yeah, we did. I mean, that was our morning play was to bulk up our SDS hedge. So yeah, we did short the S&P here. It's not that we would short the S&P, we absolutely did do that. How are our trades doing? Oh, that failed. And how's Russell? Well, Russell's doing okay. Oh, no, both failed. Oh, we're gonna blow our streak if we don't get a sell-off here. That evaporated while I was yakking to you guys. Still, the closing NYMEX is at 230, so we'll see how it goes. So what we are now is we are still one short here. This is break even. This is still below 2055, so no reason to stop it out. Let's see if we can get, should we add another one at 110? If it goes over, see, here's the thing. I might want to add one at 1010, because if it goes over 110, then I'm wrong about the trade. I thought 110 was where it was going to break down and stay below. So if it's over 1010, then I don't really want to double down. It's more like I want to probably get out at that point. It's not doing what I thought it would do. These guys are still on 2055 though. The dollar is still up over 94.50. So generally it's doing what I thought, but we'll see what happens. So no reason to change yet. And if we look at the bigger picture, which we should of course, see everybody's weakening here. Nikkei's down a bit too, even Nikkei's not doing so good. Dollar's moving up, that's putting pressure on things. We're not getting nothing in the commodity area. Apple is down a bit. Look at Apple though, it's pretty good though for Apple, back around 109. Boeing got beaten up. Remember I say about Boeing, I said this before, like always wait for Boeing to sell off. It always sells off for some reason. Okay, oil's getting pressure now up here, so we'll see if oil fails. We expect gasoline to take another poke at 146. That was a bet. Amazon rejected at 600. That's not surprising. That was an easy trade. Here's Tesla coming into their conference thing. Natural gas still taking its dive. We'll see natural gas fail that line. It's going to be great. They're going to come down nicely. I won't bet against it because I like natural gas, but it's I do think it's going to come down quite a bit. So we shall see what happens. All right. Currency wars, race to the bottom. Yeah, a lot of that. On LL question on the long call. Why put it $2 under the short put? Trade in top trades was what? Oh, okay. Sell the $10 puts. Wait. Okay. So the trade in top trades was we sold the $10 puts. Nice. Okay, fine. That means so your worst case is you end up owning for $10. Then we bought the $8 calls and we sold. Okay, so what's the question? Why put it $2 under the short put? Because it's not a why. It's not like there's a rule of that. It's that I look at the puts and calls that are available on lumber liquidators, and I don't know what they're at now, but well, the $8 calls were $670, so let's take a look. I make all these decisions are made independently. So step number one, what do I think lumber liquidators is worth? Well, I'm very happy to own them for 10. So step one, sell the $10 puts. That's step number one. Step number two. I meant to do a top trade alert this morning too, I forgot. Step number two, what looks like a good call to buy? All right, so here, well, the last sale here was $580. The last sale here was $670. So the question is, would I pay 90 cents more for a $2 lower strike? And the answer is, yeah, sure. Why wouldn't I? That's what my decision is based on. And then also, though, I look and say, well, what would I sell? What do I think is a reasonable sale? And I don't remember what it was. What was it? So the $8 calls for $670. The $10 calls for $340. Okay, so let's take a look at what I was doing there. So the $10 calls are what? $13 calls? Sell, oh, $17 calls, I get it. So yes, well, these aren't 340 anymore. I don't know what happened there. Although look at these were 320. These went for 330. Pricing's all over the place on this thing. But anyway, so I'm always going to look for a good spread. So what's the spread here? Right now, I wouldn't expect to get 670 anymore. Well, obviously, since I've made that call, lumber liquidators went up a bit. But let's say realistically 580. Like, okay, here's 580. And that looks like about the right price between these two guys. So fair enough. Maybe 6. So I would look at the 10 right now and say, okay, let's say that's 6. And what can I sell? And I can sell, I can sell these guys for 225 at least, because that's even closer to this end. Yeah, 225 is just right in the middle of these two guys. So now I say, okay, 6 minus 2, so the 10s at 6 and the 22s at 225. That's now, so now I'm looking at a $12 spread, and I'm going to pay $3.75 for that, and I can sell these $10 calls for almost $3. Now I'll pay 80 cents for the 10-22 spread. So today, if I was doing that today, I would make a different trade than I made at the time, because now the numbers have changed and I look to see what's reasonable. At that time, this was a good deal. And apparently I was right, because somebody did buy it for $670, and now you can't buy it for $670 anymore. And that's what I do. At the exact moment I'm looking at it, I look to see what's going to make a good deal. I'm not picking, there's no rule to picking it this way. I look to see what the best overall combination is. And of course that matters depending on what I feel about the stock. In lumber, the lower I go on strike, the more confident I am that bottom won't be hit. Because I wouldn't buy deep in the money calls, which get badly damaged if the stock goes down. I wouldn't buy a deep in the money call unless I really, really felt that 13 was a real bottom. I mean, if I thought it was going to 10, I wouldn't buy the 13 calls. I would buy the, if I thought this was going to 10, I would buy the $15 calls, and when it goes down lower, I would roll them down for a cheap price. That's my strategy when I do that. Or at most, I would buy the $13 calls and look to roll them down. I wouldn't spend the money now. I would spend it later. I don't think we're going to see a lower price on lumber liquidators. When we bought it, I guess it was $1 or so cheaper. But I didn't expect it to go any lower than it was. So if I'm at the bottom, I'm going to make an aggressive call and be in the money and have a nice, very high delta to take advantage of the move up. So everything is situationally dependent. It's not like there's why did you do this? It's like that's why we did it on that trade, because lumber liquidators was very low in the channel. Where's LL? Where's those charts? Okay. I mean, I don't know when that top trade was. Let's see. What are the top trades? Hello. Okay. Oh, there it was. Thursday. So that was last week. Okay, so that'll be easy. So let's see where we were last Thursday. So last Thursday, what? Log in. Okay. Maybe stupid thing. Gallery view. Hello. Yeah, that's what I paid for. All right. Well, it doesn't go back far enough anyway. All right. Anyway, so Thursday we were at $12. That's what I thought. Okay. So we were at $12, and I felt strongly that $12 was too low. It came down. We came crashing down from 1480, and because we came crashing back down from 14 back to 12, I put out a top trade alert saying, "Oh, I love it down here. Can we hit that 50-day moving average?" So I felt that was a stupid sell-off, and why was it being sold off? It was being sold off because Whitney Tilson was spouting off at the mouth with his nonsense, and so in the Morning Post I wrote, "Whitney Tilson is an asshole, and he's and pay no attention to that man behind the curtain, and let's buy lumber liquidators." In fact, that was we ended up making that a whatchamacallit trade, a institutional trade. That's how much I liked it. It became an institutional trade. It was some huge number. I forget what the number. We did a very large block of that. So yeah, I mean, I was like, basically thanks Whitney, because he goes out and bashes it, knocks the price back down. There's no actual reason that it should have been lower, so it's drifting back to where it was before he started bashing it. And you know what? Now he's going to get squeezed, and when we go back over 14, we have enough energy to the upside to pump over 15 this time. So yeah, I loved it. It was a fantastic opportunity to go long. That's why we did it. What's the line on NG you're looking for it to fail? We just did fail the line I was looking for it to fail. Charts. Trade, active trader. How are we doing? Up 50 bucks? Hey, look at that. All right. So great you don't pay attention to something that goes up for you. All right, but you know what? The dollar's not stronger, so I'm not so thrilled with this right now. But it is doing what we thought it would do. Here we are, 2 o'clock. We're coming into the final round. Gasoline's making a push higher. The Russell, okay, everything's moving around the way I thought it would. Okay, we'll leave it. What are we going to do? Oh, yeah, natural gas, right. Okay. NG. So it's this line right here where it is, 193.50. Because you see what you have here, these support and resistance lines. See how they're getting crushed down? That's what we call that triangle squeezy thing. I gotta find a better place to show it. Okay, so net gas. Okay. Oh, you're not gonna, I was not going to get that kind of view. Damn it. I need a shorter term view. UNG. How about that? Now there's no good way to show it, but look, see, you've got this thing, it's going like that, then it starts flatlining. See how it's been flatlining for days? And here you can see it's flatlining. This is what they call the triangle squeezy thing, which is not very evident on this one. But in other words, it's starting to gyrate up and down in a range. Okay, it's like when you play Pong and you have the ball gets stuck between two things, and or breakout, I guess it is, and it starts going up and down really, really fast, right? And eventually it's going to break one way or the other. That's what this is like. Okay, so it's going bit, 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 and it goes eventually. It's going to pop either up or down. It's being held down by the 50-day moving average. So either it's going to pop back over, or it's going to go and fail and retest the low, and the low would be whatever this thing is. All right, so the low would be this line down under $6. On UNG, it's under $6. On natural gas in the futures, find that. Okay, so it's the same thing, but in this case, it's a $2 line. So it got rejected, down, rejected, down, and so we're probably going to make at least here. See, now if we hold this, it's bullish. If we hold this part of the M, that's kind of a bullish move, and it probably indicates we're consolidating for a move up over $2. It's just having trouble getting over 2. There's nothing wrong with that. Obviously, you're going to have trouble getting over a big number like 2. But almost certainly, it's going to come back down. This was our buy point. Down here was where we jumped in last week. And look, see, when you expand it, it's like, whoa. See, this little thing here, down here, when you look at it more closely, this is where we got in last week, right? That 185. So we'd love it to come back down to retest our buy point. If it comes back down here, holds this area, then we're going to be thrilled to take another ride back up to 2 and maybe higher. Meanwhile, though, we took the money and ran the other day. This is like friggin' 15 cents in natural gas. It's $1,500 per contract, and we had 4 contracts. That's like $6,000 total. So, who doesn't take that? when you make it in a week, that's a $300,000 a year income. Just trading one little stupid thing. Yeah, Whitney. I wrote that. I didn't just say it. I actually wrote that last week because he was being an asshole. I hate people who get on there and manipulate stocks. It really gets me so angry when people sit there and take positions and then start telling people what's happening. Where were we last Thursday? I'll show you what it was. That was the 24th. So I'm pretty sure. Oh, still on this page. Here we go. True, blah, blah. No, when did we talk about that? Was it Wednesday? Would have to be before it. All right, so much for that. I have no idea. I'm very confused. I would have thought it would have been the same day we made the trade. I was talking about it. I'm not sure what happened there. And there's a portfolio review. Oh, yeah, that was 20. I apologize. I'm sorry. Somewhere I was talking about Whitney Tilson, but I don't know when it actually happened. But anyway, so he is an asshole. It doesn't change anything. And Pat says nothing. All right, so let's go back to looking at the futures so we can talk about how we're trading them. All right. Ah, man, bastard. All right. Oh, go. Wait, stop. All right, we hit our goal here. That's $200. We'll take it. Boom, gone. Okay. So we hit our goal. Our goal was 146, and that's fine. So we made $200. All right, that's all it is. I mean, we had a momentum play. Things were going the right way for us. We know it's Thursday. We had a good chance. Now, it can still pop over on this line, but it's almost certainly going to get rejected at least a little bit on that line. So let's take, instead of waiting and seeing what happens and then letting it all run back down on us, it's easier to just take the money and run, right? We can always get back into it. I'm not as inclined to get back into it because I'm not sure it's going to go to 147. I was pretty damn sure it was going to go to 146. That's what made it a good trade. Now, how's he doing? He's still below 2055. The natural gas is falling. See, it failed that line that I said it would fail. And so natural gas is failing, and hopefully we can get, all we're looking for is this. We'd love to see 185. If we can get to 185 again, we're going to be real happy. But again, even if it's 185, I'm not going to jump right back in and buy it. We're going to watch it and see how it does. But it's not going to happen. That's not going to happen now, by the way. So, we're just going to have to wait and see and check it out and chat tomorrow. All right. Now, since I have $200 here, I'm not too inclined to risk anything here. So if we come back over this level, I'm going to get out. Right? And again, you have to have that mindset. It's like, I want to protect my $200 gain. And again, you do that 200 times a year, that's $40,000. So, when you make $200 in a quick move like that, take the money. But now we'll go back. So now that we're out, except for this Russell one. Like B1, he's going down, so he should go down. So now we're going to watch this 108 line. Okay, because that's going to be, because you can see the line right there. You can see the support resistance lines right in the middle of their range at basically 1109. So we need a good break below. So I need momentum. So you want to see the S&P keep pulling down. If the S&P keeps pulling it, the S&P failed its line. Look at the other indexes, see who else failed. The S&P failed, the Dow failed, the NASDAQ failed. Everybody failed their line, so we're just waiting for the Russell to fail. So I feel good about that right now. I think that's certainly going to come back down below. So but now we just want to watch to see if consistently, so I'm looking at 4475, 2052, 1605, 605. I'm watching all three of these lines, to make sure they're confirming the weakness. If they start going the wrong way on me, then I want to get out of my Russell trade and take the money off the table. Why should I ride it out? And again, $80 is $80. It's like it's just all adds up. So I don't want to see 76 here. Okay, 76 will make me upset. 55 would make me, 55 would be out. I don't want to see 610 here. So I'm making sure no 75, no 610, and 205.25 now I want to see go below. I want to see these guys getting lower, otherwise we're going to get out of the trade. So now you have 7, 250, and 4. 7, 250, and 4. This is how you play this. 375 progress, 250 and 7. No change there. Now we're back to 7, 250, and 4. All right, when you're in the trade, this is what you have to be doing. You've got to watch and see if you're getting things confirmed for you. The dollar is not going up, so we're not getting any help from the dollar. Oil stopped right there at this line, so that's a rejection. Natural gas falling, but natural gas doesn't have any effect on anything else. Gasoline struggling at the 260 line, the 146 line. TLT not doing anything, so we ignore it. That's another thing, by the way. I look at things to see if they're relevant. The VIX is moving up. That's a good sign. That means people are getting nervous about something. All right, but no, 609, no good. 9, 275, 745, these are not good signs. So you just keep watching them and see if you can get, you have to figure out if it's upside or downside confirmation. But meanwhile, frankly, you could, again, you could lock this in and then pick the next thing you're going to short. So I could take the money and run on the Russell, which I wish I had done now. I could take the money and run on the Russell and then say, okay, now I'm going to play the S&P if it goes below 205, 250. And use that as the tight stuff. See, here we're back at 10. And anything above 10 I should be getting out. So he's over now. He's under 75, but barely. He's over 205, 250. So now it's not looking good. And so I don't even have to look at the Russell to know that's in trouble. 10, 275, and now 375. That's below 4. So a little progress on the NASDAQ. So you see what it is? If I'm using constant confirmation of my other indexes to see if I should be staying in that trade. And I didn't get a real bad signal, so even though I was getting nervous, I stayed in it, and now I'm being rewarded for staying in it. You have to be looking, if you're going to make a futures trade, you have to be looking at least 3 or 4 things that confirm your trade. And they have to keep confirming your trade to go. And not random things. You have to understand the relationship. Now, it's easy with the indexes. They're all related. But you have to know, so if I'm playing with the indexes, I need to look at the dollar, I need to look at the VIX, I need to look at gold, I need to look at TLT. I want to see what else is affecting the mood of the market. And that helps me make a better decision. So here we're having some nice deterioration here. So everything is kind of going my way. But now, I no longer have a tolerance for this being over 9. All right, because it's already shown me that it's not really behaving the way I want it to. So if this goes over 9, why should I stay in it? And here we are back again. See, now it's back to 250, 425, and 609, and now he's back over. See? Damn it. So it's not working out. And I'm up $50, so I should take the money and get out, right? So let's do that. So now bastard. Is gasoline being rejected? See, thank goodness we took that money, right? Oh! I hit it, but it's too late. Oh, you suck. Oh, you are kidding me. That is so annoying. All right, there you go. Gone. $20. Big deal. All right, so I got 205 and 20. It's still a win. That's all right. I'll take it. Now, how's natural gas doing? Natural gas is trying to bounce down here. It touched 192. Let's call it 193. It seems to have held that line for now. Gasoline still rejected over here, but it seems to be like working on moving up over. Up 109.5, 109.6, 109.7. So now we're back to where we shorted. But you see what it's looking like now? It bounced off this line. It held the line. And what do we know about the Russell? We talked about this earlier. The Russell If this is a real rally, the Russell should be outperforming everybody else. All right, so we would want to see the Russell holding that line if we want to be bullish. But so now I'm done. I'm out of the trade. So now with a clean slate, I go back and I say, well, what looks like an interesting setup? And the dollar, if it gets stronger, you know, it's an interesting setup. The Nikkei would be fantastic to play bullish off of 16.8 if the dollar got stronger. But you know, the dollar is not really getting stronger. It's just sort of drifting along. In fact, we go back to the other charts. Certainly, I'm sure you'll see the dollar is only making a weak bounce. So there's nothing exciting going on here. Currencies, dollar, pull back a little bit. All right, so there's you know, it's funny how you get caught up. You look at the 5-minute chart of the dollar, you're like, ooh, what's that doing? Blah blah blah. Right? Then you pull back, and it turns out it's this little dribble here. You know, once you look at it in some kind of perspective, so from 96.50 to 94.50, it fell 2 points. Okay, this line held up last time. So what you have here, and really you're falling from 97, but let's just worry about this one. So in the short-term thing, we're coming from 96.50 to 94.50. That's a 2-point drop, and if you have a 2-point drop, then you should get a half a point bounce. Or I'm sorry, a 0.4 bounce. So it should go to 94. Really here is where you'd expect to bounce. So on the 5% rule, 20% of the drop, see this drop here? 20% of the drop is a weak retrace. See how we exactly basically failed at the weak retrace on the weak bounce line? Failed, come back down, retest the low. Now we're having a weaker bounce. And that's there. That's a very bad indication. The problem is it's even going lower than this. Okay, so looking at this technically, it looks like the dollar's actually going lower. Now, if that's the case, then you want to pull back and look at a longer view. And then you say, well, if that's the case, then what do we got here? Let's say we shouldn't. Let's ignore this and say from 100 to 95 is 5 points, right? That's easy then. How much would a bounce be? A weak bounce is 1 point. A strong bounce is 2 points. So from 95 to 97.50, that's this line. I'm sorry, to 97. From 95, so from 100 to 95, and 97 would be your strong bounce line. And you see how here we fail that strong bounce line? That's a bad sign. Then we go back. Now we test the weak bounce line at 96, and we fail that. And now we're below 95. So if we're failing up here, we can't even get back above 95. That means probably we're going further down. And if that's the case, then we need to pull back even further. And now we're going to say, uh-oh, this is not good then. So now we got to look the other way. So now we say, okay, from 80, really 85, and you have years of 85. Not even 85, 82.50. So from 82.50 to 100, is what? It's the wrong number. I want to try to figure out what it really is. So 82.50 to 100. If it's 100 minus 15%, that'll be 85. But that's not what the move up would be. So 82.5 times 1.2, 99. Okay, so that's about right. So 83, 84, let's say 84 times 1.2. 84 times 1.2. All right, so about 83.50. All right. So figure it was a 20% run, and we're going to say it's probably from about 83.50. Okay, this is the 82.50 line, but and if you actually look at it and you draw a line here, I can't draw a line, unfortunately. If you draw a line here, probably you will find that 83.50 is a little closer to the reality than 82.50. So 83.50, let's say, was consolidation down here. The run to 100 then would be a 20% run, all right? And 83.50 to 100 will be 16.50 up. So that's 16.5 times 20%. 330 back, that would be 96.70. So then you find the line 96.70, which would be about here. And that would be a weak retrace. So in other words, a weak pullback would be to 96.70. A strong pullback would be 660 below, and that's going to be 93.40. So you'd expect to see a bottom. You'd expect to see bouncing off 93.40, that strong pullback off 100. So now we zoom back in, and we look for the 93.40 line, which is right here. Okay, and now we say, that is what's going on then, okay? Here's from 100 to get 101, that's the spike we're ignoring. 330 down, 1, 2, 3, 30 down. That's a weak pullback. And you see how we failed? See how coming back up, you fail a weak pullback line? That's a bad sign, right? You're failing the weak pullback, failing the weak pullback. You can't get back over it. Here we popped over it, come back, and we're testing it again. Okay, and then finally, boom, failing it. And now you test it from the other side. That's even worse when you fail it coming back up. And now down here. So now we're going to a strong pullback, and the strong pullback line is what I said was 660 below. So that's 93.40. So that's our target for the dollar to the downside. 93.40 is still bullish because all it is a 40% pullback of this run. That's still bullish consolidation. But below that, then you're into a bear turn. But 93.40 is fine. That's here. 93.40 is a consolidation pullback off of this run. And so we're just going up and down and gyrating here. And so people are going to start and here's what happens. You hit this line, and then all the newspaper articles start coming out where all these guys say, oh, the dollar's doomed and blah, 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 and it's going to zero. And, everybody starts going insane as soon as you hit these lines. And then meanwhile, it's probably going to consolidate and move back up at that point. So back to this. Thank goodness. Look at that. Oh, man, am I glad we got out of that trade. Fantastic. Okay, so everybody is moving up a little bit to close out the day with a positive note. Unfortunately, only 10 minutes left, so I'm not going to make any new trades. I'm going to have to just be satisfied with a couple $100. But, yep, see? We weren't, that's all it is. If you want to not lose money, you get out when you're not seeing a confirmation of your thing. I made $20. It was up 100 at one point, but I made $20. I'm done. It wasn't going the way I wanted it to go. So then move on. There'll be another trade tomorrow. There'll be another trade in 5 minutes for that. All right, so we don't have any trades. There are no trades here that I would have conviction of to stay in. The Nikkei is a tempting long here because, again, I think the dollar is going to come back, but because of what we just looked at on the chart, that's how we got on that topic. Because of what we just looked at on the chart, we could get weaker on the dollar, and that would send the Nikkei lower. But then, when the dollar is at 93 something, if the dollar is 1% lower, then the Nikkei will be 1 or 2% lower. So at 16.7, 16.6, around 16.6 or 16.5, I would really be tempted to go long on the Nikkei. So we'll talk about that a little bit more, especially if the dollar gets a bit weaker. I really do like that trade on the Nikkei because I don't see the dollar going much weaker than this. And the stronger dollar is good for the Nikkei, even if it's a strong dollar off an incredibly poor number. But nothing negative particularly is happening in Japan to cause this. This is all about the dollar being so weak. All right, so good. Now I'm going to wind this thing down. All right, so that's okay. I keep that streak intact. That means every single webinar in March we've made at least $200. This one being the least money we've made in a webinar. Only $225. But still, it's okay. It's good. So every webinar we're making a little bit of money, and I feel that as long as we can pay the rent, we're in good shape, right? Let's see. Oh, and that's it. Nobody has any questions? That is absolutely fantastic. All right, cool. So do I have anything else to say? Let's see what else we were talking about in this portfolio. Oh, balancing, right, yeah. So the point about these portfolios, we did this review Sunday. We did a portfolio review. And until this morning, when we did a couple of adjustments, we didn't touch the thing. And it's so useful, though. It is a good thing. If you think you've got your portfolio balanced, the best thing you can do is walk away for a few days and see how it does. If it's balanced, it's balanced. If it's not balanced, you'll fix it. All right? But you don't have to mess around with your positions every day. In fact, if you do mess around with your positions every day, how are you going to know when they're right? You can't constantly change your portfolio. All right? It's good to leave them alone so that way you know how they're performing and you can see, okay, well, the market went up 1% or 2% and everyone did well except for this guy and this guy. So then you say, well, what's wrong with those guys? What's wrong with that two positions that underperformed? What's wrong with that? You know, why did this go up so much and why did this one go down so much? Well, I thought I was more bullish, but I'm not. All right, so what I found out this morning is that we're pretty much, well, I found out this morning what I knew when we did it is because when we did this thing, here's the review, right. So when we did the review, and I quoted this morning, I wrote, I guess it would be at the bottom of it, no, that's not where I said it. Damn it. Yeah, I said we've got about 120,000 of aggressive protection for the long-term portfolio, but the LTP is very large now and can lose 120,000 very quickly. On the whole, I'd like us to be 160 to 180 protected to be more comfortable, and we'll add something next week. This being next week, we just added this morning the extra $40,000 of protection by bumping up our position where we went longer. We dropped $2 in price on 100. Don't get on 100. Contracts, dropping $2 in price is $20,000. So we've added $20,000 more upside protection and more time. And more time is the same thing as adding more money to some extent. You're getting more time to fall, so you're getting better protection. So we didn't get super aggressive because the signals aren't there to get super aggressive on the bear side, but we moved halfway towards, it's a compromise, we moved halfway towards that 160 range at least of protection. And also bought a little more time, so now we have a longer-term protection. And that's what it is. I mean, I went away. I confirmed what I thought we had on Sunday. I come back today, being Thursday, and I say, okay, good. So now we've got 3 days of evidence to show me that that I was right about this number, that we were a little bit shy because we're not balanced, because if we were balanced when the market went up, we would have stayed neutral. We didn't stay neutral. We made money. I didn't want to make money. I wanted to be neutral at this height of the S&P. So I'm making another little adjustment. And what did we spend? I forget what we spent, but we didn't spend that much this morning. SCS, $3 in the money cash. What the hell? Okay, SCS 716 cost us $152 times 100 is $15,000. We spent $15,200 out of the money that we made, and we made how much? We made $25,000. So we made $27,000. We spent about half of it to bump up our protection by $20,000. All right, so it's $20,000 actual dollars because we rolled down to, wait, was it only a $2 lower strike? No, that doesn't sound right. The September 16 calls, we rolled the 16 calls. We had the June 20 calls. I'm sorry. No, we went down $4. That makes more. Now I feel better about the play. We rolled down $4 in strike. That's a lot. So now we basically bought ourselves, with 100, we bought $40,000 more protection by rolling down $4 in strike. And we spent $15,000 to do that. That makes more sense. And we bought more time. So we did that. Basically now we're where I wanted to be as far as coverage. So we're pretty much at the lower end of my coverage range at 120. I said That's why I said 160 to 180. So we're at the 160 part. I wouldn't mind a little bit more coverage, but I'm not really, it's not important yet because we're at such good highs and we're not failing them. These indexes are still basically holding up. Oh, now we got weak again. But the indexes are basically holding up. Oh boy, am I glad we got out of RB. Look at that. Now it's failing completely. And that's right into the close. That's a bad time for them because we're coming into the NYMEX close at 235. Failing military time. At 235. And there's a sell-off. That's not good on the NYMEX. All right, so now we're back to weak. So had we been watching, we might have caught that, but that's okay. So there's nothing here jumping out at me that I would want to play right now, and I really, really think that we're going to head into I think we're going to start trending lower. I don't know if it'll happen tomorrow, but I really think next week we're going to be significantly lower. So if you want to talk about protection, I wouldn't protect with the indexes. That's very scary right now. But although see, if you want to play, you can play 17.6 on the Dow. And you can short that. If you're going to watch it, just get out if it goes over 17.6. That's a great line to short. All right, and 1110 and 1110 here is also a great line to short. These are two best lines to short, 1110 and 17.6. You use them both to confirm each other. Just make sure they're both below. And here, 2050. So if he's below 2050 and he's below 17.6 and he's below 1110 and he's below 44.75, short the one that's the lagger, which is this guy right now, the S&P. So given that they're all confirming down, the S&P becomes the best one to short if he crosses below 2050. And that's how you can play this. But then again, if any of them pop back over the line, including obviously the one you're playing, just get out. Take a quick loss. Just like we did on this one. We didn't lose, but we took a $20 gain. We took a quick out because we weren't making the money we wanted to make. It's very simple. Okay? But on the gasoline one, we had a nice run. We let it go a bit, and then we took a $200 profit off the table. That's all it is, though. Just stay flexible and don't get stuck in a trade. People do it too much. You fall in love with a trade or you make a trade and you're like, oh, I wish it would go higher. Don't wish it would go higher. Watch it and always think about what it's going to do. That's how you can make that a trade. Don't get attached to it one way or the other. Just say, is it doing what I thought it would do? No, it's not. No, out, next trade. Because you make so much money on the ones that work. Hey, like last week, they work great. You make so much money on the ones that work that why should you risk money on the ones that don't? All right, we're going to wrap it up because I got to run out of here. Anybody else question? Last question is going to go to Bourbon, who says, how do you like going long on the NIKKEI via futures or only options? No, NIKKEI, no, I always play the futures on the Nikkei. But again, only long if the dollar bottoms. So I'm not thrilled about going long here. I want to go long more like 16.5. So 2% lower than here, assuming what happens, assuming those dollar levels hit where we thought they'd hit, then I think that the dollar will bounce. If the dollar bounces, the Nikkei will come back, and then it'll be fun to play. But none of that is low enough to move the needle on EWJ, because EWJ is unfortunately not the best tracker because it's so low. We played it sometimes, but only when we're expecting big moves in the Nikkei, because frankly, it's very frustrating. 1143. It's always 11 something. Where's a picture of that? This is the ETF for the Nikkei, EWJ. What the hell was that? Something weird happened there. That's odd. I don't know what that's about. Anyway, it's always kind of in this range. Like for the whole year, it's been like here between 10 and 11. And all month it's been 11 something. So if it was, again, you've got a top of the range at 1160, where I wouldn't mind, where I'm not particularly big on shorting it. But if you come back down to 1120, then maybe it makes a good long. But a long for what? For 40 cents? I mean, you play with the options and whatever, but it's so much easier to just play the futures on the Nikkei. They move so nicely. So, we've done fantastically. We had a huge win on Nikkei futures at some point. I forgot what we were doing. Oh, I know what it was. We shorted them up here. We shorted the Nikkei up here. And you could have shorted EWJ and made some good money, but I mean, we just took a futures trade, made a fortune off of this. But I prefer the futures because, I mean, you can just make $1,000 over and over and over again. Like every time it bumps up, you make it $500, you make $1,000, you get out, it bumps it back, you make another one. You know, once you get the hang of a range, you can just play those ranges over and over and over again. It's wonderful. All right, guys. Well, unfortunately, don't have time for overtime today, but thanks for stopping by, and we will do this again next week. All right? Take care, everybody.